What is finance? Finance is a term for matters regarding the management, creation, and study of money and investments. Specifically, it deals with the questions of how and why an individual, company, or government acquire the money needed, and how they spend or invest that money. What is working capital? Working capital is a financial metric which represents operating liquidity available to a business, organization, or other entity, including governmental entities. Along with fixed assets such as plant and equipment, working capital is considered a part of operating capital. Gross working capital is equal to current assets. Working capital is calculated as current assets minus current liabilities. If current assets are less than current liabilities, an equity has a working capital deficiency, or called a working capital deficit and negative working capital. What is composite cost of capital? Also referred as the weighted average cost of capital, is the rate that a company is expected to pay on average to all its security holders to finance its assets. The WACC is commonly referred to as the firm's cost of capital. Importantly, it is dictated by the external market and not by management. The WACC represents the minimum return that a company must earn on an existing asset based to satisfy its creditors, owners, and other providers of capital, or they will invest elsewhere. What is solvency? Solvency in finance or business is the degree to which the current assets of an individual or entity exceed the current liabilities of that individual or entity. Solvency can also be described as the ability of a corporation to meet its long-term fixed expenses and to accomplish long-term expansion and growth. What impact would the purchase of an asset have on our balance sheet, income statement, and cash flow statements? The purchase would increase your asset on the balance sheet. On the year-end income statement, this asset will have depreciation. On the cash flow statement, the purchase can count as an investment activity. Why would a company fund its operations by issuing equity rather than debt? A company might issue equity rather than debt to fund its operations because equity financing isn't as risky as using debt. Though you may lose some control to the investors, you will gain valuable stability and the opportunity to take a longer view of future planning. Which is cheaper, debt or equity? Debt is cheaper than equity for several reasons. The primary reason for this, however, is that debt comes without tax. This simply means that when we choose debt financing, it lowers our income tax because it helps remove the interest accruable on the debt on the earning before interest tax. If I could use only one statement, income statement, cash flow, or balance sheet, to review the overall health of a company, which statement would I use and why? Cash is king. The statement of cash flows gives a true picture of how much cash the company is generating. Ironically, it often gets the least attention. You can probably pick a different answers for this question, but you need to provide a good justification. For example, the balance sheet because assets are the true driver of cash flow, or the income statement because it shows the earning power and profitability of a company on a smoothed out accrual basis. What is the DCF method and why might we use it? In finance, discounted cash flow analysis is a method of valuing a security, project, company, or asset using the concepts of the time value of money. Discounted cash flow analysis is widely used in investment finance, real estate development, corporate finance management, and patent valuation. This helps a business estimate what its future earnings will be based on current cash flow. When do you capitalize rather than expense a purchase? If the purchase will be used in the business for more than 1 year, it is capitalized and depreciated according to the company's accounting policies. Why would two companies merge? What major factors drive mergers and acquisitions? There are many reasons companies go through the M&A process: to achieve synergies, which means cost savings, enter new markets, gain new technology, eliminate a competitor, and because it's accretive to financial metrics. What does speculating means? Speculation is the purchase of an asset, a commodity, goods, or real estate, with the hope that it will become more valuable in the near future. In finance, speculation is also the practice of engaging in risky financial transactions in an attempt to profit from short term fluctuations in the market value of a tradable financial instrument, rather than attempting to profit from the underlying financial attributes embodied in the instruments, such as value addition, return on investment, or dividends. What does financial accounting mean? Financial accounting is the field of accounting concerned with the summary, analysis, and reporting of financial transactions related to a business. This involves the preparation of financial statements available for public use. Stockholders, suppliers, banks, employees, government agencies, business owners, and other stakeholders are examples of people interested in receiving such information for decision making purposes. What does financial management mean? The term financial management connotes that funds flow are directed according to some plan. Financial management can be said a good guide for allotment of future resources of an organization. Preparing and implementation of some plans can be said as financial management. What does public finance mean? Public finance is the study of the role of the government in the economy. It is the branch of economics that assesses the government revenue and government expenditure of the public authorities and the adjustment of one or the other to achieve desirable effects and avoid undesirable ones. What does corporate finance mean? Corporate finance is the area of finance that deals with sources of funding. The capital structure of corporation, the actions that managers take to increase the value of the firm to the shareholders, and the tools and analysis used to allocate financial resources. The primary goal of corporate finance is to maximize or increase shareholder value. What does personal finance means? Personal finance is a term that covers managing your money as well as saving and investing. It encompasses budgeting, banking, insurance, mortgages, investments, retirement planning, and tax and estate planning. What does financial control mean? Financial control refers to facts that show whether or not the business has the right to control the economic aspects of the worker's job. The financial control factors fall into the categories of significant investment, unreimbursed expenses, opportunity for profit or loss, services available to the market, method of payment. What are unreimbursed expenses? Unreimbursed employee expenses are those expenses for which the employer has not paid you back or given you an allowance for. The IRS classifies employee expenses as ordinary and necessary expenses. Friends, if you need all this information, then you can send me your email in the comment section and I will send all the information in PDF format. Thank you very much.